Hello and welcome. My name is Doug Garber, and this is Pitch the PM. We are here with Adam Parker. This is a unique episode because we're going to be talking about index rebalancing and the fundamental supply and demand of stocks. So there's three different pieces that we talk about: is the supply and demand of any given company's widget, the supply and demand of stock, and then as we've discussed with companies like CoreWeave, there's then the supply and demand of the stock available to borrow. And this is something that impacts every portfolio manager with half the assets roughly in the world being passive, is index rebalancing. It's like a mini takeout, and they're really powerful for long, short PMs. If you get one, they help you for that month. If they hurt, it's alpha you never really get back. And we're here with Adam Parker, and we're discussing one of the largest rebalances in mid-cap, and also a very large company, Palantir.
I'm also a big fan of using AlphaSense. They have a great expert library, and they also have AI technology that allows me to get to the information a lot quicker. They have a market intelligence platform that's trusted by 75% of the world's top hedge funds and 85% of the S&P 100. They use generative technology to surface key insights instantly from over 450 million premium resources, including company filings, broker research, news, and trade journals. And with the recent acquisition of Tegas, AlphaSense now offers the world's largest expert transcript library. It's 150,000 plus proprietary interviews, and that's growing by 6,000 interviews each month. Not only do you have the library, but they'll also go find experts for you.
So with that, Adam, why don't you tell us a little bit about your background and your firm?
Thanks, Doug. Yeah, thanks for having me. My firm is called Trivariate Research. We sell research to institutions, law firms, boards, management teams of companies, family offices, allocators, et cetera, hedge funds and asset managers on the U.S. equity market. We do it from a pretty quantitative lens. And then for your listeners who are individual investors or financial advisors, we have an arm called Trivector Research. We sell regular insights publications, ETF analysis, like advice for people deploying capital. It's $100 a month publication they can just get at trivectorresearch.com anytime, so they should check it out.
We do deep dives, and I'm glad to have you here. I saw your recent article in the Financial Times on Palantir, and I've even posted on Palantir. Their shareholder quarters are very entertaining, and they're even on video. So I thought a unique professional perspective would be helpful for everyone. But before we begin, I do want to tell everyone this is not investment advice. This is for educational purposes only, and that you should do your own research, contact your own financial advisor to see what is suitable for you. We are going to go through our 10-step variant view investment process and go and attack this stock, analyze this stock through there. So with that, Adam, the first question is always, what action do you want the portfolio manager to take?
Yeah, well, the title of the note that we wrote that I think you saw the Financial Times pick up on was called, Could Palantir be the best short idea? So what we think people should be doing is selling the stock if they own it, or shorting it if they have that ability to, in the construct of other positions they might have. So yeah, our clear advice would be, we think this is, I guess, the single most overvalued stock we've seen in our career.
Wow, that's a big statement. And your career's been how many years over how many different industries at Morgan Stanley?
I'm 56 years old, and I've been studying equities my whole adult life, basically. So like a long time, man. It's not the first stock we've looked at, but it just has an incredibly high enterprise value relative to its forecasted sales, and so it really stands out as anomalous in how expensive it is.
All right, we'll start with the second question is, do I understand this business and the industry?
Well, I'm not a fundamental expert on this company. I was a number one ranked fundamental semiconductor analyst for many years. I did work at a bottom-up stock picking hedge fund, and spent a lot of the research we produce is kind of fundamental in nature. But we didn't sort of pick apart the consensus expectations, which I think are for a 35% revenue growth in 2025, 36.5% revenue growth in 2025, 29% in 2026. That's pretty high in absolute terms. In our database, I think it's the 81st fastest growing company. So it's not, it doesn't justify it trading at the multiple it trades at in any way. So I'm not, sort of necessarily questioning the duration or the validity of their current government contracts or business or the things that maybe some of the fundamental experts would. But I will say, and you can actually use ChatGPT 03 deep research button or Grok. I will say we don't believe any company has ever grown from this size at the rate you need to grow to justify this valuation. So a good way of thinking about it be like, what is the quote unquote implied growth rate of this company? So this is a company that does, according to the consensus, so $3.9 billion in revenue for 2025. It's currently a 316 billion enterprise value company. So, if you can quickly divide 316 by 3.9, you'll get a rough feel for the enterprise value to forecasted sales of this business. It's insane. And so if you, again, just type into ChatGPT, like, has any company ever grown? What growth rate do you need? It's over 40% per year for 10 years. Has any company ever done that from this level? No. So that's part of the reason I can make that what sounds like a histrionic thing to say. That's the most expensive, thing in my career and actually mean it.
Your analysis is more that the stock is overpriced and expectations are astronomical, not necessarily anything about the actual company. You essentially have to disconnect the company and the quality and the value it brings to its customers versus the future expectations the stock is discounting.
Yeah, even if the fundamental expectations are totally like achievable, even if they're exceedable, even if the current expectations are beaten by a wide margin, it still doesn't justify where it trades, right? Because basically no business has grown at the rate it would need to justify this enterprise value to forecasted sales. So yeah, I like the way you phrase that.
So this would have to be the fastest growing company to grow into this valuation of all time, or have an amazing terminal value that would really have to justify this.
Yes, I think that's right.
And you're talking about it on a revenue multiple. I mean, why not talk about earnings?
You could talk about earnings. What you find with certain businesses, and obviously me telling you this is, I guess I know you know this, so I don't want you to take it like the choir is talking to the preacher or whatever. But a lot of times when people look at these high gross margin businesses, and Palantir is an 80% plus gross margin business, there's a temptation for people to say, well, what could it be bought at? And could I fire everybody below the gross profit line, or could I have some synergies on the cost line? So people might look at the enterprise value to gross profit as opposed to the stuff below that, which could be maybe engineers that are duplicated elsewhere or other things. So it's a common thing with tech stocks in general to kind of think about the gross profit. This company also has some cash, so you're kind of giving them a little bit of credit by looking at the enterprise value as opposed to the market cap. A lot of people just would take the price divided by the earnings, but maybe you're not giving them credit for the cash. So I'm trying to be generous and benign on my valuation assessment. If you looked at free cash flow, I don't think you'd get an answer that's much different. They're supposed to generate $1.5 billion in free cash. And again, it's a 315 billion EV. So you could divide that and say, oh, I'm comfortable paying, this free cash flow. So I think no matter how you slice it, the valuation is extreme. But with growth companies, people do typically look at forecasted sales, just believing that current profitability isn't a great gauge. You're paying for future profitability. And so it's a little more benign to just look at the current sales and forecasted sales.
And, when I look at it on an earnings basis, I'm seeing a next 12-month PE of, just over 200 times. So it's quite, it's 200 years at the current earnings rate to just get your money back. And even when I go out to 2026 or 2027, it's at 185 times PE or 140 times 2027. So, that's quite a multiple even on the solid growth that people are expecting.
Yeah, I don't think anybody's trading it on the price to earnings. I think they're just saying it's going to have a long, sustainable growth rate. And they've got a very promotional CEO and who's kind of tied to the Trump administration and the like. So there's a kind of a halo effect on the growth rate that people are projecting. But I don't think anybody's saying I'm comfortable buying it at the valuation level. They're saying, hey, I got to hold it because it's been up a lot and it's growing and probably nothing cracks the fundamentals here in the next couple quarters. So I'll worry about it when I get wind of the fact that they maybe are going to miss.
Yeah. So it seems like they've got, a lot of tailwinds, right? AI, good relationship with the government, contracts coming their way. So people are, they want a good retail exposure. A lot of things going for it, but the reasonable price thing is, hard to justify here if you're actually looking at the fundamental math.
I think that's right. I think that's right. I'm not making a comment on the quality of their business or their customer relationships or even the sustainability of it. I'm just saying nothing has ever grown at the rate that this would need to grow to make the math make remote sense.
Well, yeah, there's always a first, but
right.
The odds are not in your favor.
I mean, most investors now have been programmed to believe you just, whenever you find out there's a party, you run to it, you don't run away from it. And so, I get that. Like, it's hard for you to time when something's maximally crowded, show up, party hard. Yeah, there could be a hangover, but the party was still fun. Like, that's the typical growth PM's mentality now that they've been reared to believe, because when something starts to look crowded, you want to get a lot of it because it's going to get more crowded. And so that's a lot of the Palantir logic of like, look, man, it's going to get more crowded. Like, it's not going to miss, and come to the party, it's fun and all. Yeah, the valuation doesn't make any sense, but maybe that cracks in 5 years, and you're just the old, prickly guy who is focused on valuation, and that's irrelevant. And then there's a group of people who just believe that.
Yeah, momentum is a good quantitative factor historically.
Right. There's FOMO. Yeah, people just don't want to miss it.
Yeah, and then you also talk a lot about, hey, the way that the investment management system is designed is it's a part of an index in the mid cap, for example. And then if you don't want to, you can only have so much exposure or under or over exposure to a certain stock if you're a fundamental manager. Can you talk a little bit about what you see as going? So I guess this is skipping to question 5. What is your variant view versus the street?
I don't know if people realize how extreme the valuation is. So maybe a fraction of the variant view is our ability at our firm to, download and compute hundreds of things every day back in time, daily for more than 25 years, and just put that historical context around it. So the variant view is a little bit born out of just the extreme nature of what's embedded in the price. But, I think that the catalyst, I guess, if you will, is on June 28th, you have like this Russell rebalance coming. And for those of you who aren't like index investors, if you're a mid-cap growth PM, a year ago, this stock was around 50 billion in market cap, and it was pretty big for a mid-cap stock, but now it's 320 billion or whatever. And so stock's up 6.5 fold in the last year. And so it was already a pretty big weight in the Russell universe a year ago, 2-3%. And now it's like 8-9% in the index. And so even if you just think, I don't want to own this thing, it's crazy, its valuation's insane, I don't like promotional CEO, all the stuff that might make you hate it, you might have risk parameters that don't allow you to be more than 1, 2, 3% underweight or overweight any individual security. And so you were kind of forced to own 3, 4, 5, 6% of Palantir, even though you hate it. So a lot of times professional or institutional money managers own stocks for risk management purposes, not for stock picking, not for alpha. And this is the ultimate one of those where tons of mid-cap growth PMs, I think I read a statistic that only 2% of mid-cap growth PMs actively managing money have beaten the index in the last year because so few of them were overweight Palantir, right? And so it's been a real problem. So I think once that gets kicked out of the mid-cap universe, stuck in the large cap at the end of this month, that's the catalyst to have every one of them barf this thing in an indiscriminate way.
Because they're trained to do fundamental work and buy on valuation and be reasonable. And when the market's not reasonable, they look bad to their investors because they're underperforming the benchmark, because the benchmark had a kind of a clown in it, if you will. And yeah, no, it's an interesting perspective. I hadn't really thought about owning a stock, risk management forcing you to have a weight. I usually thought about, you own the stock to make money, not for risk management. At least in the hedge fund world, we always would have risk management stuff and stocks we didn't really love, or just for certain factors to hedge or risk things, but I didn't really think the long onlys took that sort of risk management approach.
I think it's the same. I think it's the
from
same.
a weight perspective.
No, I think it's the same if you're long only. Look, I mean, it's all about the benchmark, right? If your benchmark's the S&P 500, then I guess every weight every stock you own is either over or underweight that bench weight, and you got to think about it long, short versus the index. And in these anomalous situations where you've had a lot of mutual funds have something called the 525 rule, where the biggest 5 positions can't be more than 25% of the overall fund. And the so-called Mag 7 stocks, when you look like Microsoft and Amazon, Google, Meta, Nvidia, Apple, etc., it was really hard for people to even be market weight that group. So that's why you hear a lot of people say, "Oh, I need breadth," or "I want breadth," or that's a big buzzword on TV, is because what they're really saying is I'm underperforming because I'm underweight these big names, and I'm forced to be that way because of risk management.
Okay, so a lot of people are underweight because some of these stocks were 7, 8, 9%
Biggest 5
of the index.
positions were 28% of the index, and they only own 25, and so, or they owned less, but they and the other thing is that if it rallies like Nvidia to above 5%, you can't, if you sell it down, you can't buy it back up to that weight again. So there's a lot of like risk management constrictions for folks that can create these anomalies, and I think Palantir just is the ultimate one of those, because you're sitting there as a mid-cap growth PM, you're like, I hate this thing, the valuation's insane, and 6% of my fund is it, and I'm still underweight. Oh, goody, in 2-3 weeks here, it's going to be kicked out of the mid-cap universe, which of course a $320 billion market cap company should not be in the mid-cap universe, right? It'll be only in large cap. So the only debate will be, will all that supply that's coming online, because if I'm a mid-cap PM, I'm barfing that thing with no instructions to my trader, like, get rid of this 6% garbage in my fund. And then sure, it's 1-2% of large cap, but the thing is, I can be 1 or 2% underweight. So some large cap guys don't have to buy it for risk management the way the mid cap guys do. We actually typed into ChatGPT 03 this issue, and it said, no, we think there'll be excess supply. It could be bad. So we're trying to dimension the magnitude of it. I do think you'll see selling pressure in the first couple of weeks of July, which that combined with the insane valuation was the catalyst for us thinking it could be a good short idea.
Very interesting that it's such a non-fundamental, nothing to do with the business. It's just the supply demand of stock. And you're essentially saying this is 8% of the mid-cap weight indexes. It's 8% of the indexes, and it's going to come out of everyone's index. They might not own 8%. They've all underperformed. They might own 4 or 6%, but they had to own something. It's going to go to the large caps where it's only 1 or 2%, and there they don't have to own it because it's only 1 or 2%, and there might not be as much buying as selling, so you're going to have a supply and demand imbalance of the stock. And you're saying, that could be the catalyst with this ridiculous valuation. Have you actually quantified it? Have you been able to quantify it? How would you go about doing that?
We tried to think about it a little bit, but we ended up giving up and went to ChatGPT. Felt good that it supported it. It's hard because it is in the large cap universes now, and so part of me just thinks there won't be like an immediate, there's no large cap growth PM who hasn't heard of or taken a look at Palantir. They might own a stub position for risk, or they might just think, yeah, I'll just keep a little taste of it. But so you might not see a huge demand for it, but I think, again, indiscriminately, basically every mid-cap person's gonna sell it as soon as they can. So it just seems clear to me it's going to create downward pressure, and it's going to create it, being anticipatory of it. We'll see. The stock has not sold off in advance of this, so I think people are still doing shots at 2 a.m. or whatever the party equivalent is. They're still partying.
Last call's coming, I guess, at the bar.
Yeah, exactly. I think so, and you got a couple weeks left. But
I mean, I read earlier this year, Millennium had a big problem with index arb or these funds. There's a lot of funds, and I think this was the one that had issues. They front run, or they figure out they run arbitrage situations about index rebalancing. They kind of figure out who's likely to come into the index. They kind of buy the positions before it's announced, or they'll say, all right, this one's coming out. We all know it. We could do the math. And then they try and take positions before the long onlys, say, all right, this is my index, put it on my radar, I'll do the work. How much of an issue are you aware of people, starting to do the work ahead in these kind of indexed arb rebalance funds being out there?
It happens all the time, is that there's big rebalancing on the Russell value, the Russell growth, the Russell 2. You just don't see something this big. I think this is really just unusual because the size of Palantir, you've got a 320 billion market cap company that's in a mid cap index, right? Because it went from 50 at the upper end a year ago to 320 now. Like it's really just, that's enormous. There's all kinds of packages and baskets and anticipation that happens to all these rebounds for sure. And you look, like, even for your everyday guy, like you think about the S&P 500, if I put you on the spot, I'll put you on the spot. And if you're enumerate, it kind of makes my point, because as a serious professional investor who worked at some of the best firms in the world, like, if you don't know this, it wouldn't surprise me, because it's just not something you did. You pick stocks, but like, what percentage of the S&P do you think gets kind of kicked out each year in the S&P 500? Like, if you had to guess, how many stocks each year get added, and obviously by definition, like, taken out of the S&P?
15.
It's not a terrible guess. So you don't have to delete this part of your podcast. The actual average long term is 30. So 6% of the stocks. And if you're good at math, so I think about the cumulative impact over 10 years of that, right? I'm kicking out companies that are slower growing, worse balance sheets, and I'm adding things that are more interesting, that are fast growing or whatever. Even after the financial crisis, right? Like, you kicked out Wachovia and Bear and Lehman and Merrill and whatever, and you added like juicier things that weren't. So the cumulative effect of that upward balance is massive. And so people are always trying to play the names that they think are going to get added, or sell the one. Like, so this is there's a cohort of guys who are constantly trying to anticipate these rebounds. It's just really the mother of all of these, given how big Palantir is. I guess that's the point.
Yeah, so we've talked about the active management part of the world, but roughly speaking, half of the ownership of stocks is passive. So now you're talking about another, 170 billion that passively owns, Palantir. Maybe it's a little less, plus or minus, depending on the retail ownership. They don't just rebalance, they
kind of have to track it. Right.
They rebalance more frequently, and they don't just do it when it's, some of them, like, there's some indexes that are like, hey, you're in the world index, it won't matter. But there's some things that say, hey, that we're passive, and we either own not just the S&P 500 is our benchmark, or the S&P 600 or 400, but the passive ones don't do work. They're just going to own the weight no matter what. So that's a lot of selling. Yeah, if they own 6%, they can't be 4% or 2% if they're a mid-cap fund.
I just typed
if it's passive.
Yeah, I just typed this in while we're talking. Palantir is currently in 354 U.S. traded ETFs, right? A couple of them are levered, right? So if you can triple long Palantir, right? And just, if that stock's down at 9:30 a.m. to 3 p.m., there's like a trap door, or at 3:45 p.m., that ETF's got a lever. Like, so there can be a lot of like exaggerated price movements on the way up, as we've seen. And then I think also on the way down, if this rebalancing affects things. And it's not like the current valuation will be a floor. I mean, it's 3 times more expensive than the second most expensive. So it could go down 67% and still be expensive.
So I guess the key is to take those 354 ETFs, see how many of them are, mid-cap index versus large cap versus just world, and then see how many of them have to sell.
Individual, or all kinds of weird baskets. So what happens is as it gets smaller and smaller and smaller, if it does, there could be an exaggerated price movement. So I'm just making a bit of a gamble by pointing this out, that with this big rebound coming, with the insane valuation, this is a risky stock to own, and I would be selling it. I mean, that's really the point. But and there's no historical like justification for something at this valuation level.
Yeah, it's an interesting one, because you have a non-fundamental supply and demand imbalance catalyst with more shares coming to market. You've got a stock that is, by all ordinary measures, overvalued.
Right.
And you have a lot of retail people who love it, and they fit all the themes.
You gotta remember, the average person thinks that low price is good. So like in a lot of countries in the world, quantitative model wise, there are signals called low price, meaning buy a stock that's at a low price, sell a stock that it's a high price with no denominator consideration. Like every question you've asked me obviously includes what about the earnings or sales or cash flow? Like you've had a denominator. But like, so a lot of people don't think, they just think Palantir is going up and it sounds good and I buy it.
Yeah. It's so you have your catalysts lined up, and then you also have the fundamental catalysts of backlog and earnings growth, and those seem to be going in the right direction now, with more AI in the government and that theme, and they've got good margins, right? They've got very good margins, and
yeah, that's right.
So wanted to just kind of go down the list here. We kind of talked about the catalyst here, but question 8 is, what is the company worth if my bet is right?
So if you just assume it trades at the second most expensive company level instead of the most expensive, and you assume the estimates are correct that are in consensus, it should be worth about 50% less in a year or so. It could be worth way less than that, but I just think assume that it becomes the second most expensive stock. So I think you're playing for, a pretty serious, recalibration of their of their valuation. Now you might say, well, Adam, like, come on, man, like I need a catalyst to get there. And I think the catalyst would be either, current consensus numbers are that the revenue is going to decelerate. Usually, these businesses that have decelerating revenue or gross margin contraction start to see multiple contraction. This one probably won't have margin contraction just because it's the business it's in, or it's going to be a high gross margin business. So decelerating revenue, maybe even less upside than people think, maybe, and God forbid, a miss in the second half of the year. And this is the kind of stock that could be down 29% in one day. Of course it could. So, that's sort of the way I'm thinking about it.
And what is the other side of the bet? If your bet is to sell it or short it, there's always the other side. How does this stock go up even more? What does that case look like? And what's the probability of it?
Probability is real in the near term for sure. And it would just be simply that stock's up a ton. They've got sort of alluring and attractive, business. Like the party is awesome, and why break it up? Like the same thing causes all bubbles, right? They do software, it's platform, they hit every possible buzzword, securing data, AI, world government custom. Like it's all, the Venn diagram of awesomeness, right? So I'm the jerk who's saying, beautiful person walks in the room, has a great personality, and I don't like them because everyone else does. Right, or whatever. Like that's the
little game theory here.
Yeah, that's the game theory. I think in the longer my time goes out, the more confident I am the valuation will erode. But if you're saying like, yo, I need my year closes June 30th, I'm on a July 1st to June 30th fiscal year, and you're telling me to short Palantir right now for 2-week trade, like I don't think so. I want to short some after into and after the rebal as a little risk reward, catalyst. So yeah, I like it. I like shorting it. But if I'm short this thing, I probably got to be long something else that has a little bit less of a rebal impact, that has the same flavor of hyper growth, junk.
Well, there's definitely some other
maybe I long Apple Oven, or I long MicroStrategy, or I long something else just to make sure that I'm isolating this rebal effect on Palantir, and not the kind of, AI euphoria and other stuff that might last longer. And to be clear, like I'm very bullish on AI deployment, and I'm not negative on technology. It's really just a commentary on the extreme valuation level that this company has ascended to.
And why put AppLovin or MicroStrategy on the long side here? Why are those good hedges?
If you wanted to just say, I don't want to short, retail flows and sentiment and momentum, I just want to short Palantir, you could isolate Palantir against some things. That's all I meant.
Yeah, no, that makes a lot of sense. You kind of put a couple other stocks that are kind of AI winners.
Same family of euphoria. Yeah. MicroStrategy is a Bitcoin company, and you trades on Bitcoin per share. So that's got, so maybe
times 2 or 3.
Yeah. It's a levered Bitcoin company. Yeah, that's true.
Well, not just levered, it's just trades at a premium. It's like,
they're buying back they they're buying back stock, so it actually the Bitcoin per share is like a real financial metric for them. Yeah.
Yeah, I'm looking at the short interest here, and it's interesting that you're kind of out on your own here. I'm looking at the shares short has gone from called 160 down to 40 million shares over the last, call it 2 years.
Yeah,
So
whenever stock goes up, 7-8 times in a year, it tends to clean out the shorts.
can take the pain. So you're saying this is the time where this will be the catalyst that gets them in. So you made a comment that you want to be perhaps sell it ahead of the event, but also then after as well.
Yeah, I think it's not just like most fundamental people say, well, the stock can anticipate the event and it'll all be in the price by the time it happens. But in this case, I think you want to be around for the mechanical part, which is like the actual selling that you see and happens. Like, I think, you can put the position on now and then benefit from the actual supply coming online not being met by demand. I don't think it's like all going to be in the price in anticipatory fashion because everyone knows about the rebal. I think it's actually going to be the flushing of the shares that I'm going to want to stick around for.
How many days in advance do you think people start anticipating this and lining up their book? And
I'm not a total expert on the Russell rebal, but it's definitely like when I worked for Morgan Stanley, there was like a whole team that worked on this.
Okay, so that's the team that's quantifying how many shares are for sale coming out of the mid cap versus large cap. I used to see these things circulated on the desk.
There's going to be like if guys are sector weighted mid cap growth PMs, there's going to be like 8% move in your sector weight based on this one stock moving out. Like tech's going to be 8% smaller, and consumers, like there's going to be huge moves in like the sector weight. So there's a lot of rebalancing that happens here. And there's a lot of, like you said, a lot of money's running passive. So if somebody chooses a mid-cap growth option passively, like it's going to be a much different constitution on the 1st than it is on the 30th.
And there could be a lot of buying of the other mid-cap names. And I wonder if this is such a big name that this could actually have a,
correct,
if they're smaller, less liquid names that have perhaps high short interest or where you want to, those could be very interesting if you're a trader. So again, if you're going to short, like, how do you lose money on this? Like, I'm trying to figure out what's the risk, what's the other side of the bet? How does it continue to go up?
Multiples are more volatile than earnings, right? So it could always get more expensive for sure. Perhaps they announce some increased government business and the revenue estimates come higher. I think if they guide up in the second half of the year and sort of exude confidence, if Carp's in there with Mr. Trump, or if there's some sort of, we've seen things like that have the Trump appeal, like DJT or Fartcoin or stablecoin or other things that the valuations can go, pretty high when there's, so you could get like, it's a big retail stock, right? So you could get, more flows into it if people think it's going higher.
Yeah, so maybe not a company to actually be short on earnings if the fundamental earnings and backlog are still doing well.
Volatility of multiples is always higher than the volatility of earnings. So, the two possibilities to answer your question with like intelligence would be either the earnings have upside or the multiple has upside or both. And, it's hard for when stock's already the most expensive stock I've ever seen in my career. You're asking me like, could it get more expensive? So I'm saying, yeah, man, it could. It's already crazy, so it's possible. And then the question on the fundamental side is, it's also possible that they announce some new projects or deals or things that get people thinking, yeah, it's the market's right, like it's up for a reason, and the reason is that the numbers are coming up. That hasn't been true, and it's not that fast growing. But if it accelerates to from 28% expectations next year to 40%, the stock probably goes up.
Yes. So that's the trick. Is do you know where the line is between irrational and irrational exuberance?
It's already irrational because, and I think it's crossed the line because I know no company this size has ever grown this fast ever to justify the stock price. Maybe like Google for 3 years or Amazon for 2 years, but all like from way smaller revenue levels than Palantir is now.
Question number 10, is management aligned with ownership? It doesn't seem like this is a long-term call. For you, it seems like it's more of a supply-demand structural imbalance here, but of the stocks. But I always like to ask this question: is management aligned with ownership?
I haven't looked. It's a good question. We do track open market insider sales by the C-suite, and I haven't looked at it recently for this company, but look, Peter Thiel's in there big. He's a big supporter. That's a positive for it. It's got a really A+ list of institutional investors for sure. So, and then Alex Karp, who's the CEO, has, I mean, to answer your question, like he's got 6.5 million shares of $135 stock. So he's got pretty close to $1 billion of it. I could argue that's aligned. I mean, I feel like that's aligned, but maybe people could say, well, that's kind of a punk amount relative to the market cap. He's only got, he's got less than 1%. And, Vanguard and BlackRock own 17% of this thing passively or whatever. It's massive.
Do you have a position in it yourself? Are you short?
No, our business sells advice and research, but we don't have a active money management arm. So we're not involved in it long or short. And legally, we cannot be, when we reference any individual securities, we cannot own them or short them in our personal life for compliance reasons.
I don't have a position right now in this. That could change in the next, by the time this airs, who knows? But right now I don't have a position. I'm trying.
If you short it and make some money, think of me and think of me well.
I'm trying to unlearn 20 years of trading and be a fundamental investor with a few high conviction, deep valued with catalyst names, and not kind of do monthly catalysts that aren't struck.
If you're going to buy deep value with the catalyst names, there's exactly zero chance you're going to buy this stock.
Well, this could be a funding one. Yeah, that's I'm not gonna. I wouldn't buy it. I obviously I do have a history shorting, and if I were in my seat, if this was in my sector, I think this is for a long short PM. This is I'm almost a no brainer short with this sort of event. I'd obviously quantify it, the amount of shares. It could be a funding short with a catalyst. Obviously, I'd have a view on the backlog, the growth, any catalyst coming up from the government, earnings revisions, the fundamental stuff. But you don't actually, that comes out on the quarters usually. You can still have this supply-demand imbalance and have a position, for the next couple of weeks or month. I mean, those books turn over almost monthly. It's a large liquid stock. And honestly, the more, index rebound, passive, we talked a lot about the active management, what it means, but on the passive side, it became a bigger and bigger contributor to alpha, that it became something we looked at in almost every thesis, just because
I can say some of the biggest, most successful, most well-known multi-billionaire hedge fund managers requested the Palantir note. I can say that. So I think there's interest in this being a possible big short idea, because the way you get paid, as you know better than me, is the earnings surprise up and you get a higher multiple on the higher earnings, or vice versa, like the earnings miss and you pay a lower multiple. And this one, at such a high multiple, feels like you do have the chance for a lot of multiple contraction if things do slow. So I think there's some of the biggest and most successful short sellers ever had requested and read this Palantir note.
Yeah, it seems like it's a question of when, not if it cracks.
Right.
If this is catalyst, and then really it's like it's a retail sort of name. So once the Mo's gone, the Mo's gone.
Right.
And
if it goes down, the best indication it'll be down 50 is if it's down 20.
Chase the Mo. That's why you want to be after it after. Those are the good ones where you don't care what happens on the event because you still want to be there after. So if it goes against you, you don't have to walk in your boss's office like, that was the catalyst. Sorry. You want to continue to be there. You have
that's right. I think that's
durable.
Right. I think that's right.
Valuation thesis.
I think that's right.
Thank you, Adam, for coming on. I greatly appreciate it. This is super interesting, and I'm glad we got to discuss sort of an index rebound, because it does touch every thesis that we talk about is that part. So thank you.
Yeah, I enjoyed the conversation. Anyone else who's listening, I'd love to go to trivectorresearch.com and sign up for our newsletter, our insights, ETF analysis, monthly webcasts. You can ask me questions. We do a lot of work like what's the right way to dollar cost average, and why you should stay fully invested in the market, and what's the right amount of cash, and all those kind of things that people are struggling with day to day. So love to have people subscribe, and appreciate getting to talk to you, Doug.
Yeah, thanks for sharing your work. I appreciated. I learned something, so thank you.
Awesome. All right, take care. Be well.
All right, bye.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.